Over the past few years, the stock market has been a roller coaster of returns. While the S&P 500 and NASDAQ have given investors decent gains, there's been someone who's been outperforming them all. We're talking about a financial wizard who's earned an astounding 186% return on his investments in just 3 years. You might not believe it, but this expert, Michael Burry, has a track record that even the pros admire. Now, you might be curious about how Michael Burry manages to achieve such incredible returns consistently. Well, he has a secret weapon. He plays both sides of the market. When opportunities arise, he buys, and when he senses a storm brewing, he shorts the market. It's like the conductor of an orchestra making sweet music no matter which way the market swings. Hold on to your hats because we're about to uncover Michael Burry's latest trade idea that's sending shockwaves through the financial world. You see, Michael Burry has made some jaw-dropping investment choices that paint a rather gloomy picture for the American stock market's future. But what's got everyone talking is his $1.6 billion short position through put options. Hold up, don't let the jargon scare you off. These options are like superpowers that let you predict the future of the market, and Michael Burry has chosen 2 ETFs, the SPY and QQQ, as his weapons of choice. These ETFs are like crystal balls, giving you a glimpse into the broader market's health. Now, you might be wondering what SPY and QQQ stand for. They're basically windows into the heart of the US stock market. SPY tracks the S&P 500, which includes big players from various industries. On the other hand, QQQ follows NASDAQ 100, giving insight into how tech giants and other leading companies are performing. Here comes the bold part. Michael Burry has put his money where his prediction is. He's gone ahead and bought put options on these ETFs. But what's a put option, you ask? It's like a bet that the prices of these ETFs will tumble in the near future. In other words, he's standing up and saying, "I see storm clouds on the horizon." So mark September the 20th on your calendar because Michael Burry's latest move could send shockwaves through the stock market. With his proven track record and history of bold predictions, it's clear he's not one to take lightly. Whether you're an experienced investor or just starting up, this is a story that's sure to keep you on the edge of your seat. Get ready for a market revelation like never before. Now, let's dive into the heart of the matter. What's propelling Burry's unique perspective? What does he see that others might be missing? Is he angling for potential gains, or is he bracing himself for impending losses? These questions are like magnets for the curiosity of both market analysts and enthusiasts alike. In his most recent filing for the quarter ending on June 30th, 2023, Burry has tantalizingly offered us a glimpse into his investment portfolio that raises more than a few eyebrows. It turns out he's not just taking a bearish stance against the US stock market, he's also casting a shadow on the tech sector. But how's he doing this? Well, he's turning to a financial tool known as put options. So what exactly are these put options? Think of them as a financial safety net. It's like a contract that gives the buyer the power to sell an asset at a specific price, aptly named the strike price on or before a certain date, called the expiry date. Now, you might wonder, why would anybody want to do this? Essentially, it's a way of betting against the value of the asset dropping. Imagine betting that your house's price will decrease. If it does, you can sell it for more than it's worth at that point in time. But of course, this kind of financial maneuver comes at a cost. The buyer pays a premium, akin to an insurance fee, to the seller or writer of the option. If the asset's price falls below the strike price minus the premium, the buyer starts to reap profits. However, if the asset's price remains above that level or the option expires worthless, it turns profitable for the sellers. Back to Burry's intriguing move. Based on his recent filings, it seems he's taken a plunge into put options. In fact, he's snapped up a whopping 20,000 put options on the widely followed exchange-traded fund SPY, which closely tracks the S&P 500. But that's not all. He's also secured another 20,000 put options on QQQ, an ETF tied to the tech-driven NASDAQ 100 index. Now, let's talk numbers. These put options that Burry has gotten hold of amount to a staggering $739 million. What's the significance? Well, if he decides to exercise these options, in other words, if he puts his bets into action and the market goes in the direction he's predicting, he could potentially cash in a jaw-dropping amount. It's a daring move, and it's definitely set tongues wagging. Is Burry envisioning a downward spiral in the market, particularly for the tech sector? Only time will reveal how these strategic investments will unfold and whether Burry's foresight will translate into reality. Inverse ETFs, also known as short or bear ETFs, are a fascinating tool designed to provide returns that move in the opposite direction of a chosen benchmark index, sector, or asset. These ETFs achieve this by utilizing a combination of financial instruments and strategies, such as short selling, derivatives, and options contracts. The goal is simple. When the benchmark index goes down, the value of the inverse ETFs is crafted to go up. One of the primary advantages of inverse ETFs is their potential for serving as a hedge against market downturns. By holding an inverse ETF alongside traditional long positions, investors can mitigate potential losses during periods of market decline. This risk reduction aspect is particularly appealing to those who align with Michael Burry's bearish perspective on the market. However, as with any investment tool, inverse ETFs come with their own set of considerations and potential drawbacks. Tracking errors can arise due to fees, expenses, and market volatility, causing inverse ETFs to deviate from their intended inverse performance over extended periods. Additionally, these ETFs are designed for short-term trading and may not align with long-term investment goals. Their potential for higher volatility, especially leveraged and inverse ETFs, necessitate careful consideration and risk management. Inverse ETFs hold the potential to be a valuable tool for investors looking to align with a bearish perspective on the market. However, their effective use demands careful thought and education. Seek advice from financial professionals if necessary, and remember that no investment is entirely devoid of risk. A diversified investment strategy remains key to managing exposure to market fluctuations and achieving long-term financial goals. These inverse ETFs aren't designed for the long haul. Over time, they tend to lose value due to compounding effects and management fees. So if you decide to venture down this route, it's essential to keep a vigilant eye on these funds and make necessary adjustments to align with your investment goals and positions. Another robust approach that echoes the wisdom of the ages is diversification. It's akin to the age-old adage, don't put all your eggs in one basket. This strategy serves as a safeguard for your investments during market downturns, while simultaneously enabling you to tap into opportunities across various sectors and regions. How does this diversification work? It involves allocating a portion of your funds to assets that exhibit a negative correlation to the US stock market and the tech sector. Think about incorporating assets like bonds, gold, commodities, foreign stocks, or alternative investments into your portfolio mix. This balanced approach can help mitigate risk and promote resilience in your investments. If the world of diversification feels complex, fret not. There are tools at your disposal to guide you. Asset allocation tools and robo-advisors can be your trusted companions in crafting a well-rounded investment portfolio that aligns with your risk tolerances and financial aspirations. While directly mirroring Michael Burry's investment path might not be the exact route for everyone, there are certainly savvy strategies to explore if you share his sentiments about the market. Remember, when it comes to investments, an informed decision is invariably the best decision. That concludes our exploration of this topic. Feel free to share your thoughts in the comments section below. Also, don't forget to like the video and subscribe to our channel.